This episode is brought to you by Matcha. Stay tuned for more information about them later in the episode. What's up, everybody? I'm Scott Melker, and this is the Wolf of Wall Street's podcast, where twice a week I talk to your favorite personalities from the worlds of Bitcoin, finance, trading, art, music, sports, politics, basically anyone with a good story to tell. Now, most crypto enthusiasts watch price action or charts, buy dips, and try to take profits when the number goes up. Others take a more nuanced approach and read between the lines to really understand the structure and activity of the crypto market. Willy Woo, today's guest, is arguably the best on-chain analyst in the crypto space. With an expert-level understanding of what's going on behind the scenes, it's my hope that Willy can help us all better understand what's happening in the market, what he's currently watching, what he expects for the remainder of the current crypto cycle, and beyond. Willy Woo, thank you so much for coming on the show, man.
Hey, great to be here. Thanks for having me.
So listen, something that just stuck out to me that I heard in the last couple of days, Jerome Powell, the chairman of the Fed, did a meeting and said that a digital dollar would replace the need for private cryptocurrencies. I'm curious how you would respond to that amazing comment.
Well, yeah, I actually did a tweet recently. It was like recalling, Bitcoin encoded that, on the Genesis block, the chancellor on the brink of a second bailout was essentially central bankers on the brink of, back then it was bailing out the banks, which had failed us. And now they're on the brink of essentially releasing the central bank digital currencies, which really, if you think about that, like what's happened since 2008 is that the government has, fused together the policy of fiscal and monetary. Meaning, like, if you're not managing your books well, you get a free pass and you get to print lots of money, meaning you can steal from the poor and give to the rich and keep going as if nothing's going to happen. And essentially what they're doing now is saying, well, we're going to essentially make that a production technology, and we're going to release central bank digital currencies, a digital dollar, out to everyone so we can actually instigate this very, very efficiently. So, I'm thinking, well, if you would look at that, you're essentially stealing from the poor, giving to the rich. And every kind of, if you look back on history, every time that's happened, it's ended in either revolution or like a totalitarian society. So in effect, what central bankers are doing is anti-democratic, so it's absolutely no substitute for Bitcoin. I mean, Bitcoin is the opposite to that. It's the exact opposite. In fact, it's encoded in the blockchain that this is a solution to what central banks are offering, which is a digital dollar.
Right. What really made me scratch my head was the idea that it made private coins obsolete, which is so colorblind. Clearly, that's true for the government because, like you said, central banks want utter and complete control of the monetary supply, and a digital dollar would do that. But for your average citizen, it's quite the opposite, right? I mean, a CBDC makes cryptocurrencies that are private more important for us.
Very much so. And it's, we're in a bubble, right? We're totally in a, crypto, Bitcoin, well-educated bubble. And I kind of am out of touch with what, the people on the street think about this. I'm interested to know, because it's very, very scary for all of us inside the world of Bitcoin that understands a little bit more than the rest on how money works. I'm curious to see how the general public will receive this, because it's scary.
Yeah.
It's really
I think
scary.
we are in a bubble, as you said, definitely an echo chamber in our own community. I'm curious if you think, though, in the last year and a half since COVID hit and, lockdowns and all of the printing and infinite QE, the increase in the monetary supply, do you think that your average person has at least some inkling now of the idea that, holy crap, maybe this is wrong? Like, maybe we can't just print money? Because I think your average person never thought about their money in the past.
Yeah, maybe, certainly crypto's taken huge gains and a lot more people are looking at it. And, one thing I've noticed is that since COVID's hit and everyone's been stuck inside their houses for over a year, There's been a lot of, people on YouTube researching. A lot of that's come out in a lot of conspiracy. A lot of people are very conspiracist and anti-trusting of their government. So there's that. I can imagine a large breadth of the population really mistrusting government and going, whatever they want to do, we don't trust. So yeah, maybe.
Do you think that central banks and I guess governments and regulation in general are still the largest threat to Bitcoin's future?
Ooh, that's a good question. If I was to think longer term, I think maybe the threat to Bitcoin's future is really a threat on its own decentralization. I actually don't think, I don't think central banks. Yeah, I don't think that central banks is the long-term threat. I think that money is more powerful than the central banks and the money printers. History usually sides on whoever has. Well, let's say totalitarian societies don't really last very long.
Right.
And these concentrations of power, they're very much aberrations in the long arc of history. And we're going through, this digital revolution, and we're talking about a internet native technology, a monetary technology, monetary base, which is completely native to the internet, versus some sort of central authority, kind of clunky. It is not really a digital dollar, it's essentially a private network. And so it doesn't work. Like we've always seen we've had this big technology change. Like the last time it was the industrial age, right? We changed the structure of money. It went from commodity money, bits of gold, to paper money that was backed by gold. And it's like a layer 2 because it can move efficiently across a globalized society with an industrial age, right? So that was necessary to facilitate trade. But then you'll notice that the power structure changed from kingdoms to nation states. So like right now we're in nation states, and they want to create a digital dollar and a centralized banking system, whilst we're going through this technical revolution, which is saying, no, we want something a little bit more fluid than that. And usually that what changes is not, the technology goes forward. It's the power structure changes. So I do think that the nation state as we know it is coming to an end much quicker than most people think. We think this might be a century kind of thing. The rate of Bitcoin's growth, 1 in 8 people will have exposure to it in 4 years. It'll double in the next 4 years. No, double every year after it. So we're looking into the decade. Majority of the world on this network. It's faster than any other network in history. So we're looking at a major power shift in the next 10 years. I think that we'll start to transition from very powerful nation states to like smaller nations, city states. And I think that'll be profound. I think those would be the areas that are prosperous. So yeah, I feel like this is like the last ditch effort from a dying power structure. And so to answer the question, yeah, I don't think that is the risk. I think the risk is if Bitcoin fails internally from centralization.
Can you talk a bit more about that?
If it becomes too centralized, then it fails on its original objective, which is really a kind of democratic monetary democracy, essentially. If you centralize the control of the money, then we're back to where we started, very centralized control. And if that was centralized and controlled by a nation state, then this whole future that we think about, where we have like a fair monetary system ceases to be fair anymore. So yeah, I think that's the biggest risk. And I think also the people don't really understand that as the most important thing in Bitcoin is its decentralization. So a lot of people talk about, XYZ coin is more scalable. It has this or that, faster block times or whatever, but that's not really important when you're talking about winning the game of being the monetary base, which is like $100 trillion. You need that to be decentralized. So I would rather have a 10-minute block time than a nanosecond block time with something that's highly centralized, because that's a failure.
Right, or less
Yeah.
secure. Yeah, or less secure, obviously. So speaking of decentralizing, then, how do you feel about the fact that China has finally, seemingly, is actually banning Bitcoin mining, which in my estimation, long-term is a good thing because it's less centralized in China. But I'm curious as to, with what you just said in mind, the impact of what's happening in China now.
Yeah, for sure. It is definitely reducing the centralization. It's a really good thing that's happened. It's ridiculously bullish in the long term. Short term, it's short term often moves in the other direction, which we're seeing. Yeah, it mitigates a lot of attack. It mitigates an attack from a state actor like China attacking the network. Also, there's repercussions, subtle ones, like like maybe you call it miner extracted value. We've seen in 2017, there was actually this particular market environment where you're actually incentivized as a miner to attack the network. And they did, right? In 2017, there was a phase where the block was 93% filled. It was very congested. And at that point, if one miner controlled, or a cartel of miners controlled the network, what you could do is spam the network, actually pay and outbid the fees in the mempool, and create this kind of Dutch auction where everyone would have to bid higher for their fees, or their transactions wouldn't be processed. And so effectively, these miners were spamming the network so that they could extract more value in mining. And so that attack vector starts to reduce, and actually that attack vector becomes very, very important later on in Bitcoin's kind of maturity, as the kind of the inflation rate drops, the block subsidy, the new blocks that are being rewarded start to diminish to zero. All we're left for the miners is that fees market. So what they earn from those fees becomes very important, and usually in that setup, the fees are quite high, the blocks are very full, and that incentive for a miner to spam the network only works if you control enough of it, so that you're guaranteed. If you control 50% of the net, well, say 30%,
51,
you'll get 30% of those fees back, right? So those kind of when you decentralize that part of the network, it reduces a lot of the risk to the network. So yeah, it's hugely important.
I'm laughing sort of because it made me think of what's going on with Bitcoin SV, or BSV, Satoshi Vision, at the moment, where they're finding trading being frozen on a number of exchanges because it lacks the things that you're talking about, and they're experiencing 51% attacks.
Exactly. I was like, they put out a statement saying this is an illegal attack on a network, but actually no, it's an incentivized attack on the network because you designed it wrong. Big blocks create that. So
interesting karma for Craig Wright, I guess, at the moment.
Yeah, he's supposed to be this rocket scientist according to his own words, like he's a genius according to his words, but he's designed a network that incentivizes attack from its own miners. And he didn't know that, but that was really clear. I mean, I saw I saw these incentives work out in 2017 as the whole thing became congested.
So listen, I got into Bitcoin late 2016, and I came in strictly as a trader. I think, like a lot of people, I came for the dollars and stayed for took the orange pill and stayed. But one of the arguments when I first came in, because I'd been trading other markets, was Bitcoin's amazing. It has no fundamentals. You can just look at the chart and trade the chart. It doesn't matter, right? So obviously you learn later that it has fundamentals, just not the same as a corporation, right? You don't have earnings like Apple or Amazon, but you have on-chain metrics. So that's clearly where you focus. I'd love to hear you talk about what those important fundamentals are of Bitcoin as far as on-chain metrics. And for anyone who doesn't even understand it, to talk about why that's what you focus so heavily on.
Yeah, so like, most investors, probably the most common understanding around investment is in stocks and companies. So we're very used to like a company and a balance sheet and profit and loss and the evaluation on, the kind of money they're making and the growth of that company and the money they'll make in the future. Whereas Bitcoin can't be considered this, it's a commodity, it's a digital commodity. The only fundamentals you see in it are essentially people buying it to hold it. And so if we were to do this with gold, well, you can't because it doesn't have a blockchain, so you can't trace it, right? So, gold's kind of private, but on the other side, there's no fundamentals you can track. So with Bitcoin, we have this blockchain, and it's really interesting because we've got the first time a fully visible ledger, and you can see investor movements. You can see flows of capital. And when we look at the blockchain, we're essentially looking at, short-term and long-term demand and supply by these investors and speculators and all the different participants, including miners and exchanges and whatnot. So effectively, we're doing that. Like I think my first indicator that was published was NVT, and it was kind of billed as the price earnings ratio of Bitcoin. And I'll describe this as an example because we're used to a price earnings ratio. A company has earnings, and then we run a ratio to its share price, and that's the PE ratio. And whereas Bitcoin didn't have earnings, right? It's not a company, but it does have activity, and the activity is correlated to volume, because when you see volume on its blockchain, not volume on the exchanges, because that can be wash traded. You can do all sorts of volume games in there, but it's not indicative of long-term investors. So when you look at the long-term investors moving coins between participants, that's if you see movement of coins, that's usually movements from a buyer to a seller, and so you can get a volume of investment activity there. And so it turns out, the more investment activity you get in the network, the higher the valuation. The correlation is very, very high. So what you do is you run the ratio to that, and effectively the earnings is kind of like the investment activity, the volume, and that became NVT. So that's a very simple example of trying to draw demand and supply when investment velocity is very high, and the price isn't reflecting that. It means the market is not pricing that incorrectly. So often what you'll see is the price runs up afterwards once it figures it out.
And were any of those signals present on the run up, I guess, from 3,800 all the way to 65? But I think more people would ask, were any of those signals present that the drop was coming when we reached the top?
Yeah, so interestingly, with the story goes back to COVID, the COVID crash in the first and second quarter of last year. Like we saw the price pull back from 10,000, it flash crashed to 4,000, recovered to 10,000, and it went just sideways, and it was very correlated to stocks, and people were saying this is crap, it's not a safe haven, gold's going up, it should be performing, and it's not. Do something, it's just moving up and down with stocks. And if you look on chain, you'll see that something else happened. The inventory on spot exchanges, the speculative inventory, I call it, that was starting to deplete as long-term investors were starting to scoop up all those coins. And you could see it also on the blockchain, because you can look into you can cluster all the wallets together and all the address spaces, and you go, oh, that's one person, that's another person, that's another person. And you can do a historical analysis of their wallets, and you can then categorize the guys that are long-term investors who don't sell, they just keep accumulating, and the speculative kind of holder that moves coins in and out of the exchanges, So You could also see the long-term investors who are just buying, scooping up all the coins, and the speculative guys giving up their supply and being bought up by these long-term guys. And it just carried on for like 9 months, and it went all the way to October. So effectively, there was this huge supply shock that was forming, and the market was completely not pricing that in. So when it did get priced in, by late October, we did this run up, and it went from $10,000 to $60,000. And if you were a technical analyst, you go, oh, oversold by 20,000, it was oversold. And just all your technical indicators would be saying, this is completely bonkers. The market's gone bonkers. But actually it hadn't gone bonkers. The market was bonkers going sideways, not pricing in supply shock. And it was just finding equilibrium, finding its new balance, and effectively pricing that supply shock in the 50,000 range. And so, with that, we on-chain things looked pretty, it's still looking kind of, momentum was bullish, but there were a few key things that happened. Whales started dumping, and like I certainly didn't think it would pull back to this level. Like we saw like a little bit of dumping, but I kind of thought we'd go even higher. But effectively, it wasn't until like mid I think 45,000, 50 to 45,000, things looked extremely bearish. I put out a very bearish call at around that zone, and that was, you could see a lot of coins moving from previously strong hands back to speculative hands. And so like a lot of the guys that had bought the coins in the last quarter of last year and the first quarter of this year, they bought, kind of sub 20,000 was taking profit. And those guys started dumping. That's what you could see on chain. You could see, and these guys weren't small fry. They were whales. They were effectively like 1,000 Bitcoins or more, like ridiculous amounts of like, and these were noobs effectively. Like in 2017, we had, as a bull run comes up, it collects a lot of new investors, and those noobs get frightened in the volatility kind of ups and downs, and they sell out and they get snapped up by the smart, hands that are well capitalized. And in this year, what we saw was the noobs were like hedge funds swinging, 50 million, 100 million, 200 million. They're taking profit. And so, the people who like know Bitcoin and it's like, yeah, this is going up over the long term, they're snapping it up, but they're getting crushed by the sell power of, these whales. So that's effectively what's happened now. That you can see all this on chain. And now we're in this sort of sideways band where a lot of liquidity is being dumped back onto the market. So there's a lot of coins that are being reabsorbed by long-term holders. And that process has been going for two months now.
So 8 weeks of weekly candles. If you look at the chart, and I don't know when this will come out, but 8 weeks have basically gone below 34K and then closed above. Every time it drops below that level, it just gets absolutely eaten up and bought back up. So it really is interesting to watch. And I'd never heard the perspective that you just said, that now we have whales that are noobs, which is not something that we ever had before. But it makes perfect sense, because a hedge fund has people to answer to, right? If you're a hedge fund manager and you're up 4x on an investment that you made a couple months ago, you literally have to sell.
Yeah, you have to rebalance. You have to
rebalance.
By protocol, they have to do it.
Right. Yeah. I mean, it's absolutely a necessity. What I find funny, I actually did something I rarely do, and I told Twitter that I was going to be speaking with you today and asked for questions. And across the board, you get the same sort of thing that I get whenever I'm on Twitter, which is, why didn't you know this was going to happen? Why didn't you tell us? And I always laugh that people assume that we have crystal balls, right? And that we can literally tell the future. But people are like, he was telling people to buy at 60K. Well, so was I. And frankly, I still think you should have bought at 60K, because I'm thinking about a decade from now and not a month from now. right? So do
Yeah,
you think it's just that people are too impatient and too focused on now?
I think it's very reflective of the cycle we're in. It's a bull cycle, and we're collecting a lot of new investors, and they're new to the market, and they think it's a crystal ball, right? And if you're a long-term trader, you're generally like 55% correct. If you're a good technical trader, you might be right 55%. You make money because of your risk management and your stops, right? If you've got extremely good analysis skills, you might be 60%. Like the best algorithm I've ever built was winning 60% of the trades, right? So it's very seldom you get above 60%. And so it's like that, like with the back trace of on-chain that I've done is about 80%, right? It's 80%, and people expecting 100%. Well, if you can get 100%, well, why would I just keep that like secret
Yourself
and
forever.
I'd be the emperor of the world. The emperor of the world is 100% reads the future, it's Eye of Sauron.
Yeah, it's
So,
really true. Guys, I really hope that all of you are not still trading on the old platforms like Uniswap when there are much better options like Matcha, and now Matcha has upgraded to 2.0. Now, I've told you about Matcha a number of times. They have limit orders, which these other platforms don't, which is absolutely incredible. So you don't have to sit there staring at your screen waiting for that perfect moment to enter or exit a trade. And they also aggregate liquidity from all of the different platforms, finding you the best price and reduced fees. But now they have Matcha 2.0 and have added so many awesome features. Matcha is now the only DEX with an integrated fiat on-ramp. You can put your dollars directly onto the platform. They also now have OTC trading for orders between 1K and 1 million, which is beyond huge. And maybe most importantly, Matcha now supports trading on Polygon, meaning that those gas fees will almost evaporate completely. Now, if you guys want to check out Matcha, which you absolutely should, you can do that at the wolfofallstreets.link/Matcha. That's the wolfofallstreets.link/Matcha. Please check them out. I'm telling you, it will save you so much money and is such a superior experience. Do it now. Speaking of people being patient versus impatient, which is something we see constantly in the market, another recent argument that made me shake my head and laugh was that Bitcoin has failed as an inflation hedge because we've seen CPI numbers up in the United States. May over May was roughly 5%, and June over June was slightly higher than 5%. And alarmingly, Bitcoin didn't immediately go up, so it's not a good inflation hedge. So I'm curious.
This is also one of the things in the markets, right? The market's irrational in the short term, but it's usually very accurate pricing things in the long term. That was exactly what I talked about earlier, like 9 months of supply shock. The market did not have even an inkling of how to price that in until eventually the supply ran out and they had to figure that out. So like right now, we're in this zone where the market is ridiculously irrational and caught up in fear. And the supply shock currently values Bitcoin at above 50,000 if you can shake off the fear. The velocity valuation of Bitcoin is in the high 40s. Supply shock is in the 50s. Stock to flow ratio is, what is it, close to 70,000? These are the fundamental valuations on Bitcoin. And the market is stuck in fear mode in the 30s. I kind of suspect that it's more than fear. I think that it's being manipulated down for more accumulation. Massive amount of accumulation happening right now.
Yeah.
So, it's often the market is game theoretic to make the smartest and richest trader more money.
Yeah, I mean, the longer we go sideways, the more
do you trade like that?
I mean, I don't trade much anymore because Bitcoin went so high that I had the luxury of becoming a really passionate investor and not having to bother trading, which is something that I've always, traded with a small part of my stack. But I personally, I believe that this is an exceptional time to buy. I mean, I like a 55% discount on an asset that I want to retire on.
It's ridiculous.
Yeah. And I don't care if it goes to 20 or 25, it's irrelevant. Right. So, and that, sure, that could happen, but everything I'm seeing now, sort of like you're talking about, once again, now we sort of have people getting impatient, price ranges endlessly, and eventually they wouldn't have sold at 35, but now they think 35 all of a sudden is a great place. And we're seeing those newer speculators getting impatient and selling back into the hands of whales who are accumulating, and the real whales, not the noob whales.
Yeah, the real ones, the ones that are really stacking. We're in a zone where the smart money has completely stopped selling. It's at a local minimum. We call this destruction. This is another metric. You can look at the age of the coins moving per volume, moving between investors. And whenever it reaches a low of destruction, meaning those coins that are moving between investors are young. That means the sellers are noobs at maximum noobishness. And whenever that bottoms, yeah, that's a time to buy, and it's just bottomed in this last week. We're at max noob selling, and the OGs are not selling. So that's they're buying, right? So that's another one right now. If you wind back the clock to 2018 to now, the network growth in terms of users you can see on the blockchain, it's gone parabolic, right? It doesn't go parabolic, like the user growth on the net. I'm talking about parabolic on a log chart, like we're used to.
Yeah.
Normally it does that sort of, it grows and then it starts to taper, the growth rate starts to taper off. For the last 3 years, the growth rate has been going parabolic. Never been seen before. So is it an inflation hedge? Well, don't look at the price, look at the fundamentals. It is. People are flying into Bitcoin. It's not being reflected in price because the price action is irrational. And sometimes it's suppressed by very strong hands that are scooping more. So there's all sorts of weird effects, like Elon Musk effects on the short-term price. But when I look at on-chain, I filter all the noise out and I can see the long-term movement in capital and fundamental valuations on this network. And price doesn't often it tracks, but not always. And when it doesn't, those are great opportunities, because never in the history of Bitcoin has the fundamentals been not played out. They always play out.
Yeah,
it just
always catches up.
time.
Yeah, I've always made the argument that price and value are two very, very vastly different things, right? Because the price is being set by speculators, and it really is incredible, as I've gone down this journey for 5 years, to be able to actually quantify that value with on-chain metrics and following people, like yourself. Because at the beginning, you just see price and you say, this is what it's worth. Right. And I think obviously we all know that it's worth more. And the notion that an inflation hedge would be defined in such a short period of time is such nonsense when you're buying it to hedge against inflation 20 years from now.
Yeah, it's often when inflation hits, there's a delay mechanism before everything goes haywire. But going back to the short-term pricing, like we were in an era, 2018, 2019, even early 2020, you could describe the price of Bitcoin as, it's not fundamentally driven. It was effectively a random walk in the direction that would liquidate the most amount of traders on BitMEX, right? And you could actually, if you could figure out how much money could be made by liquidating the most traders, that would be the direction Bitcoin would move in. It's like this car swerving, take out as many traders. And effectively, that's a speculator game. So it doesn't follow fundamentals. It does track it once the price deviates so far, like it goes so far below fundamentals, that fundamental investors come in and scoop up. They absolutely scoop up those coins so it can't drop below. And so, it's a waiting game. It's patience, and certainly this last 2 months has been very much a patience game. Accumulation bands are patience. It's about patience. Yeah.
Well, we were joking before we started recording that Plan B, who introduced us, was smart enough to get on a boat for the summer and go away.
Yeah, mind you, I think that all fireworks is going to break loose in next week. I kind of think that's going to happen it's going to be next week or the week after. And he'll probably kicking himself on a boat. He's probably got internet access, but I don't know. He's not a trader, so what does it matter?
No, not at all. It's just funny. So I'm curious if you have a oh shit price, where if it drops below this price, you're like, oh shit, I was wrong. Maybe, maybe there's something false here, or is it really price is completely irrelevant when you're looking at your analysis?
Well, there's definitely a oh shit price if I'm in a leverage trade.
Always.
Like usually the oh shit happens if the fundamentals start to swing, right? Sometimes these market events that happen where price action actually changes the fundamental, like we saw that in the short squeeze in, was it 2019, when price broke out of the $4,000 range and it just went all the way to 14. And it squeezed investors, and effectively it was well overvalued. But as it was running up so fast, investors started to get FOMO, and then we started to see the fundamentals started to conform to the price action, and it pulled the fundamentals up. And so, I mean, if you can create enough fear in the market, the fundamentals can change, and then I would go, oh shit, yeah. But luckily we're in this zone where, as the price is going down, everyone's going oh shit and buying, and so like it's just like really juicy right now, and it's really great because crypto Twitter is full of bearishness. Everyone's
it's like floating in the Dead Sea. There's so much salt. It's unbelievable.
It's like because I was tweeting bearish tweets after bearish tweets based on on-chain analysis in 2018, the bear market of that, and they hated me, absolutely hated me. And now I'm doing bullish tweets and they're hating it, saying it's going to 20, but it just says to me, like, actually the whole thing's flipped. Everyone wants to buy Bitcoin, but they want to buy it cheap, and they want the $20,000 Bitcoin price so they can buy it.
Those are the people who buy 50. Those are the people who buy 50. Those are the people who buy it at 50 on the way up when they're finally in disbelief. That's how markets work. I don't know if it's going to go up or down, but right. I don't know if it's going to go up or down, but I do know that when it's seemingly everyone wants to buy at a lower price, they all buy higher. That's just, I mean, you can see that in the history of markets everywhere, right? That's not unique to Bitcoin.
And it's interesting now because on-chain analysis is very widespread, and everyone's got access to the charts. And so people are posting very bearish on-chain analysis too. But I'd have you know that the on-chain analysis for the bearish stuff is fundamentally very bad analysis, and it's flawed analysis with major gaps and misunderstanding of what the data they're looking at is actually saying.
To that end, I'm actually curious. So obviously traders spoof and manipulate the market all the time. Manipulate because it's a free market and there's no rules against putting up a buy wall or sell wall. Can on-chain metrics be spoofed or manipulated by big players? Can they send a whole lot of coins to one wallet or another to make you as an on-chain analyst believe that something's happening that's not? Or would they?
Yeah, it's a lot harder to. It's not impervious, but there's different tiers of data, and for example, you can spoof addresses. Like active addresses is very easy to spoof, and there's a high correlation to price historically to active addresses. But some of the very much more sophisticated data we've got now, like Glassnode do on-chain forensics to cluster all the addresses together and go, that is one person, and so you can't really easily spoof that. You can't fake being a million people. Literally, you need to fake being a million people to make a difference on the network, and that's very hard. That's a large amount of capital to deal with. The cost is prohibitive. You need probably a lot of development in wallets to be able to fake that kind of stuff, and even then would look at the amount of capital you're throwing. So if you're trying to spoof that stuff, you better be worth like 10, 20, 50, $100 billion,
right, for it to even be worth it.
Particularly and also we filter out a lot of the stuff that's new. Like we want to look at the coins that have aged. So how can you, like, those coins that were 5 years aged moving between one participant to another, you can't fake that. Like, you can have to wait 5 years before you try that scam again on the network. So it's very difficult to fake that, the really good data. Like there's very rudimentary data that's given for free, but the really good stuff costs money, and that stuff is hard to fake, to get access to that data. And that's the data, I'm working with. And, all the stuff on Twitter is the cheap free stuff. And none of the people that have access to this higher tier of data is posting anything bearish.
Right. Which is very interesting. I saw you say that on Twitter, that basically if you have access to the good data, it's very hard to build a bearish case.
Yeah, it's very hard. And it's crypto Twitter's fortunate because there's a number of us, William Clemente is also tweeting at that tier of data. I do a bit of it. I try not to tweet too much these days because I'm just sick of the BS trolling. Yeah. So forget it. I mean to be a service, guys, but forget it.
A voluntary beating is not really high on my list of fun things to do. I also tweet less for the very same reason.
Yeah, exactly.
But I'm curious. You talk about obviously 5-year-old coins being moved in a large tranche, something that you wouldn't be able to fake, but also to what end would you even try? I'm curious, when you see things like that, how easy is it to identify whether perhaps that's an OTC deal, or is it perhaps just somebody changing their custody or security? How do you know why these coins are moving?
Yeah, that's a hugely good question. It's like when you see that, you'll see it in one dimensional network. So you will see it in, say, like dormancy or the destruction of coin. We call it destruction, pretty much the aging, the fine wine aging of these coins and wallets. Right. As they just get destroyed, their age, you go, oh, there's a blip here. But then, of course, no one chart is the Holy Grail. You need to look at, we have like 400 or 500 charts of the network, and you go, well, this could mean A, B, or C. So it's a process elimination. So if it's OTC, you will go to the OTC chart, and because we're tracing that, right? You can say there's some amount of data showing what's happening on OTC desks, and so forth. Like there's for example, someone posted like the wallets of 1,000 Bitcoins or higher is they're reducing, meaning whales are selling. Well, it doesn't mean whales are selling. It could be wallet consolidation. It could be a number of things. So then you need to track how much is, is it exchange balances? Because they're the biggest whales out there, which is Binance. They'll look on. They hold the most wallets of over 1,000 Bitcoins. Are they? Is it supply shock? Is it actually everyone's buying coins and taking it off Binance into cold storage because they're stacking hard? That's bullish. It's not bearish. That whales are
right.
And so you need to look at all these dimensions, and once you have the good data and you look at all the different possibilities and eliminate them, then you can ascertain what is happening in the network with much higher probability than just, it's kind of a guess with past correlations. Like right now, active addresses dropping through the floor, which is correlated to price, right? When you see this thing dropping to the floor, it's been fuel for a lot of bearish people because it's like, there's no activity. That means that the network's not growing. Actually, what's actually happened is we've had 2 rounds of miners shut down. And so the blocks are being processed at 1/3 of the rate. So obviously the activity in the addresses has to go to 1/3 of the rate because they can't process at the same speed. So when you have to take that into account. So there's all these sort of things you need to know about the network when you're going to do analysis. So
yeah, listening to you talk about it is really enlightening because I'm on Twitter. I see hundreds of these charts that don't consider any of that. Right? It's very binary. This moved. It went from here to there, and then they ascertain what that means.
Right?
But causation, correlation, right? So clearly, you have to be looking much, much deeper. And like technical analysis, people become basic beginner technical analysis. They draw a couple lines and they think they're a master. It's probably very much similar with on chain. You look at your 3 or 4 things that you track and you think that you then understand what's happening, but probably not the case.
It's not usually the case. And I mean, I see people posting XYZ as a counterpoint, on-chain analysis as a counterpoint. And sometimes I don't want to even get started because it's like a tweet thread of 10 charts and then none of them are analyzed properly. And then when I say, I don't want to get started with this because there's so much wrong in this, and they'll just say, oh, that's because you, then they'll say something really trollish, like it's because you've got no way to refute my strong argument. Like, no, it's just because I've got only a certain amount of time in the day. I'm doing a lot of things right now. So
I'm curious.
Twitter's a big time waster sometimes.
Oh yeah, the ultimate. So I'm curious to pivot. Do you think that we get to a point in the future where Bitcoin is viewed by Wall Street or your average individual mainstream adoption at a level where it's just another asset in your portfolio, where it's so mainstream that people go, I have a portfolio of stocks and bonds and some crypto and something else? Or do you think that we remain sort of this fringe asset and fringe community?
I think we've probably got another 2 to 4 years to be considered fringe. From 4 years onwards, definitely it'll be mainstream. Just in the adoption numbers, I think we're now in the transition from fringe to mainstream. We can see that from obviously the whales dumping, the hedge funds dumping. It means that I've been in this game. Wall Street has been in this game for the last year at very large capital compared to what we're used to. And probably doesn't take much conversation to realize that some of the smartest people on Wall Street are now bored with traditional finance and really excited about what they can build and what they can do in crypto. Certainly the yields inside crypto are huge. This market is so inefficient. Talking to some Wall Street guys, they look at the markets here, they run their models across it, and their jaw drops. They go, "What?
It's like 1980 for them." Yeah, it's like 1980 for Wall Street.
They're like making 20% per week by running arbitrage from their standard Wall Street models onto here, and they're like, "We got to get into this, because the volume's big enough now. They can run a fund doing this stuff." So that's the thing right now. This market is so inefficient that Wall Street's coming in, and anyone with that kind of background is coming in and adding efficiency to the market, and you can almost measure the adoption as the the crazy inefficiencies start to close. But if you're in traditional finance, you're lucky if you're getting maybe a few percentage points on your cash, but the yields in crypto are very easy to be double digit, triple digits if you really know what you're doing.
That's interesting because a lot of the excitement for mainstream is the yields that are being passed on by these companies, the Voyagers, BlockFis, Celsius, Nexo, Amber, of course. But as you said, they're obviously having to take advantage of some arbitrage opportunity to pass those yields on to their customers. If the market becomes more efficient, won't those yields steadily disappear for the mainstream?
Yeah,
and we're seeing with BlockFi already. BlockFi went from 6% to 1%. I think largely because of the GBTC premium disappearing in a matter of months.
Yeah, true. Those yields are completely trashed in a bearish phase. But yeah, and also the volume is very, very low right now. So I think some of the loaning out goes to market makers. They need the access to the liquidity to be able to market make, and because the volume's so low, it's very low yield.
Don't need it.
Right
now. Yeah.
But they're still making a little.
I mean, everybody's still making money, but it is just interesting because we know that this market will become far more efficient with time and those opportunities will disappear. I mean, remember in 2017, even as just an average person, there was a time when you could arbitrage between exchanges on Bitcoin with a $3,500 gap. It would be trading at
Yeah,
19,000 one place and 15,500 somewhere else. There was a week where I was just cycling Litecoin between Coinbase, Binance, and Bittrex for 5 to 10% difference as fast as I could move it. Free money.
manually, right? Manually,
Free,
correct?
yeah, I was literally
like,
oh, it's going to take me 30
exactly.
minutes to send.
Exactly. I remember when Bitcoin cash fork came out, and remember like there was huge inefficiencies. I think I creamed 5 Bitcoins that day just moving moving coins around.
Right,
It
that
was just
doesn't exist
ridiculous.
anymore. Right, and so I guess we can see that that's probably a statement of how much more mature the market is and how much further it will mature. Interesting though, like we all talk about Wall Street and hedge funds, and it's exciting that they're here and they're moving money around this market. But isn't like rationally that sort of contrary to the original purpose of Bitcoin? It's like, you have the sort of short the banker, long Bitcoin mentality, but then they also make the number go up. So we cheer them. But for your average person, say in Venezuela or Lebanon or Iran, who cares about Bitcoin, they don't want Wall Street and institutions here, right? They want to use Bitcoin as money or a store of value.
I think it's a little bit more nuanced in that like we're not saying like the bankers are here, which I'm sure they are coming in. Well, they definitely are. They are. It's actually really interesting. I'll get to that later. But like what I'm saying is the smart guys, it's the rocket scientists that train to put rockets into space, being hired up by some quant firm to build some front-running software to beat the market, and then they're coming over to crypto to go, wow, it's inefficient, let's build some stuff to make it efficient. It's not like the chairman of Goldman Sachs is coming in to do that, because those guys come in and they want to dominate and control the currency. These guys are coming in to build cool stuff to add to the ecosystem. And ultimately, I think I don't think I've come across anyone who doesn't really, like, after working with it, really believe in the ethos of it. And usually in a much more sophisticated way. So, like, you look at SBF over at FTX, right? He's exactly that. What I'm talking about, like a little bit of Wall Street background and coming over, like, whoa, look at all this stuff. Let's build some cool shit.
Yeah.
So that's what I'm talking about. Meanwhile, you got the bankers coming over, and they're coming over in a really interesting rock and a hard place, because they make commercial and retail banks make money by essentially propagating debt and expanding the money supply, through their process of loaning out and then getting deposits and loaning out, and they expand the money supply. And effectively, the central bank goes down through this food chain. And now with central banks effectively saying, we're cutting you guys out, we're going to issue our own currency, central bank digital currencies. The retail and commercial banks are now faced with two things that they can do. Option one is to roll over and die. And option two is to be a Bitcoin bank, right? Essentially be on the other side like of the divide, because really it's coming down to central bank digital currencies and free and open peer-to-peer currency. And so you can see one by one, like what is it? DBS Singapore is banking Bitcoin. Standard Charter, I think, is initiating something in Europe. Morgan Stanley moving, JP Morgan. And this is like they're all coming over to Bitcoin, and they don't have a choice. So that's the interesting thing, is on that side of things, those guys are coming into Bitcoin with I think their tails tucked, because they're forced to, with the valuations now no better than Coinbase, right?
Yeah.
And SBF now, like, I don't know if he was joking or was being serious, but it's like, it's not out of the question to acquire Goldman Sachs. Like,
or
it
the
gives
CME.
You a little, well, and the CME, right? It gives you a little bit of a completely flip side thing. We're not that small anymore. Definitely not at the current growth rates.
How big of a smile did it put on your face when you read that? Because to me, that was the funniest and most amazing news story in ages. Just the fact that, the thing is, he means it.
Yeah, right. It's backed by data. It's backed by the growth rate, right? Like, this thing's going to It's going to 100 trillion, if not more. I imagine the economy is going to get a lot bigger, just because productivity is improving. So yeah, like this is probably a 10x above what banks, the size of the scale of banks, you know. So yeah, I mean, we're so used to, was it 12 years of being the little guys, but now we're in this zone of breaking out of being little to becoming mainstream. And you know, you can tell that because the chairman of central banks are now, you know, fudding Bitcoin,
They're
right?
talking about it.
So
I mean,
right,
regardless of what they're saying, the very fact that they're talking about it is astounding.
it's
They
it's
have to.
like the very largest banking powers in the world are now scared of this little thing that we thought was a toy a few years ago, you know. So it really is, and that's like, it's, you know, what is it? It's roughly 160 million people have exposure to Bitcoin today, but that doubles every year, you know. So it's not actually about it's not actually about the size we are in, but it's the growth rate. And the current network growth rate is the fastest growth rate of any technology
Technology.
we've ever seen in the history of mankind, which means that we'll be at saturation within a decade.
It's
um,
unbelievable.
I mean, I'm kind of wondering how long will it take for central bank digital currencies to actually roll out and be ready? Because they've got a race on their hands. If they can't get this done in 5 years,
It's over. Yeah, they've
it's over.
lost.
It's
Yeah.
the crypto is de facto. Bitcoin is de facto. It's too late.
Yeah, I
They
agree.
really only got a window of probably, I don't know,
3 to 5
2 years.
years. Yeah, maybe two. Yeah, I don't know. Yeah, I think you're right. I think I mean, China's going to roll out, but the others are going to be very slow.
Yeah, China's going to be a very, well, it's going to be quite a closed. I imagine it'd be quite closed because
Yeah.
how they do it, they'll be the fastest. They'll be the fastest. But you know,
Easy to be fast when you have complete control over what you're building and don't have to ask anyone else's opinion. It's so funny though, talking about what you mentioned with SBF. I had Steven Stoneberg from Bittrex Global on the show, and he said, you know, it used to be like the bankers were the rich guys. And then in like the 70s, 80s, whatever, the hedge fund guys came in. They're like, haha, you're a billion. I've got 2 billion. Like, we're the rich guys. And now you have 28-year-olds who are worth 10 or 20 billion and just completely, right? So the future of wealth is going to move to the crypto billionaires. I
yeah,
mean,
that's interesting.
and they're going to be 20, 30 years younger than the guys who made their
Yeah,
money on Wall Street.
and this is the interesting thing is like, you know, the founding fathers of America were essentially millennials when they wrote the founding documents, right? And I mean, there's been cases like this in Europe. I think, is it Estonia, I think, is one of these countries where it was like the average age of the politicians was in their 30s. Like a lot of progress happens when the younger generation get to rewrite the rules according to the changing times. And like, what's interesting now is the new power that's rising as, you know, the millennial generation, but you know, the cream of the crop are making billions in crypto right now,
Yeah.
and they have very fine understanding of how monetary markets work. So I see a huge power change, you know, right now. It's like, if you ever read the book The Fourth Turning, um, you know, it really describes every 4 generations they go through archetypal kind of changes, and every fourth turning. Last one was the Great Depression going into World War II, and we had a major shift of regime and infrastructure change. You know, all the strong institutions we were built in present day was built then, with high integrity, and now they've been dismantled. And we're actually in that fourth turning, in the fourth generation of that happening now. And it's the millennial generation that are now very capitalized with the ones that are capitalized, like SPF. They're very, it's new values. It's going to be a really interesting time in the next 10 years. I think it's a ridiculous amounts of change we're going to have. And I think it's going to be positive. I'm not doom or gloom. Might be a bit of pain in the short term, but I think it's
Always
positive.
is. So you talk about this thing going to 100 trillion, right? So what does that mean for Bitcoin price?
Yeah,
I
per
mean,
Bitcoin, right?
right, yeah, $100 trillion per Bitcoin, obviously. If anybody's listening,
It's
Willy Woo has
possible.
just predicted $100 trillion Bitcoin. Just so you guys hear.
It's possible if USD goes to zero.
But reasonably, cycle tops, is there a last cycle? Does it eventually just become a stable asset, because it's a standard? Where's this thing going in your mind?
I'm more and more siding on the last cycle. You can even see it on the chart. It's a drunken walk right now of demand and supply. We've had parabolic rises and a blow-off top in 4-year cycles for 3 times now. And this time we're doing these kind of weird drunken walks of demand and supply as different participants come in and different effects happen. And so I'm kind of like with Michael Saylor, which he said to Laura Shin, there is no top, Laura. I think we might just not have these 4-year cycles because they're predicated on a supply shock from the halvening. Every 4 years, the sell pressure from miners halves, and the sell pressure from miners is getting pretty small now. We're at 1.7% inflation rate per year from miners, and the next halvening goes from 1.7 to like 0.8% or something like that. That's infinitesimal in a supply shock when exchanges are already almost double that. Like the sell pressure from exchanges, if they were to sell all of their fees revenue into fiat, not saying they do, but they do sell some of it. The potential for their sell pressure is 2 times what miners do. The sell pressure from Grayscale's ETF, well, it's not an ETF, but their fee management fees of 2% is about 5% of all the miners combined right now. So as ETFs start to climb, their sell pressure comes in. So there's all these kind of mature market like demand supply impacts that are really starting to reduce what impacts miners have, which is what the 4-year cycles is predicated on. So I think we're now in the last cycle, and some people say, oh, we're getting lengthening cycles. No, it's just like we've just made a binary shift from 4-year cycles into correlations in demand and supply to macro markets.
But it's funny when you say the last cycle, I think your average person, the first thing is going to be like, oh my God, that's bearish. Like, this is it. It just went up and we're done. But I think the point is that it will just continue to rise, and even a 50% correction will be more temporary, and we don't have to wait 4 years to start going up again.
Yeah, thanks for the clarification. I mean, I like the last cycle. It's so dramatic, but you might use Dan Howard's super cycle. I mean, that sounds like we might skip a cycle, but I think it's like the cycles are ended, and now we're just, the only way is up through a drunken wander.
So just to conclude, Willy Woo says that 1 Bitcoin will be worth a few $100 trillion, and that we're in a super cycle that never ends. I got it. Perfect. I love it. No, but I know that that doesn't mean that Bitcoin is going to a couple $100 trillion, but it's always good to get a joking soundbite. So I know that we're up against it here with time. Where can everybody?
It's good to get a headline, right?
Yeah, exactly. Don't worry. So where can everybody follow you after this and keep up with what you're doing?
Mainly on Twitter, if the trolling is under control. It's Woonomic. I also write an investment newsletter, essentially forecasting on-chain demand supply. So if you're a long-term or even a medium-term investor, and you need that kind of intelligence, whether it's just to like give you a little bit more confidence of not to sell this asset. Or, even if you're a trader, you want to do swing trades, it's good to get visibility. It's not going to tell you buy here or sell there. It's going to give you the kind of regime environment we're in, and give you a bit more, full visibility of what's really happening. So you can make your own, risk management decisions. And so if you want to look at that, it's linked to my Twitter account. That's the easiest way to find it. So
yeah, it's amazing. I highly recommend to everybody. It's on Substack. I know it's an incredible newsletter. Well, thank you so much for taking the time to do this. Really an honor and very, very enlightening. And I think that when you do have someone who really understands the on-chain analysis and the fundamentals, it gives you a lot more confidence in the asset long-term. And it's easy for your average person, I think, to get very caught up in the news cycles and what they see on Twitter and not really understand how important and powerful this asset is and how early we still are.
Yeah, exactly. Well, it's been really fun, Scott. Been looking forward to talking to you all day. So it's been
awesome. But thank you, man. We'll do this again down the road and see if we actually hit a few hundred trillion. Okay. Thank you.
Okay. We'll get you later.